Lots of new people are coming into the market. Stocks are very high. Well, I will say that anybody who has quick success on Wall Street or anywhere is probably going to lose a lot very quickly. I did have at one point, yes, I had a tremendous success early in the day when everybody else was going broke. I had tripled my money in 6 months. I said, hooray, this is so easy. I'm going to be rich. I'm going to be rich. Well, needless to say, a few months later, I lost everything.
Jim Rogers is a renowned investor and financial commentator who has made a name for himself in the stock market. From his failures to his successes, Rogers has always been open about his experiences in the market and his predictions about its future. He believes the stock market is a necessary part of life and that investors should always have a comprehensive understanding of the markets and their investments. Through his own experiences, Rogers encourages individuals to be mindful of their decisions and always approach the stock market cautiously. He also provides valuable insight into current market trends and offers advice on how to make the most of current market conditions. Whether you're an experienced investor or just starting out, Jim Rogers' words of wisdom on the stock market are sure to provide invaluable insight. In today's video, Jim Rogers talks explicitly about the stock market, including his failure, success, and prediction about the stock market. Please watch, like, and share this video. Also, drop your comments and thoughts below, and remember to subscribe to the channel for more related content similar to this. Without further ado, let's dive right in. We begin with a short clip of Jim Rogers.
Who knows? Who knows? I'd only been in the business a short time, but I could see enormous exuberance around me. I could see economic problems developing in the world, I thought. I could see problems developing for the U.S. dollar. So I said this is all going to collapse. I didn't have enough experience, Kevin, to know what I was doing, but fortunately, I got it right. And I knew that puts would be a big payoff if things did collapse. And so I took all my money and bought puts. And it worked.
I love
It
it.
worked. As I say, I sold my puts the day the market hit bottom. That's a good lesson to learn, but
Yeah.
it taught me to lose a lot of money eventually. Well, Kevin, I have learned that I'm the worst market timer in the world. I'm the worst short-term trader in the world. So whatever success I have had is I try to find something cheap where there's change taking place, positive change taking place, and then I buy it. And if I get it right and the change comes, I can own it for years if you buy these things when they're really ignored and cheap and big changes are taking place. That's on the long side. And on the short side, just the opposite. When everybody is wildly enthusiastic about something and think it's going to go on forever, if you can sell it short or buy puts, chances are you'll make a lot of money if you have staying power.
Jim Rogers describes his experience in the stock market as a relatively inexperienced investor. He recalls a specific instance in which he believed there were economic problems developing and the US dollar was at risk of collapsing. This led to him leveraging his money and purchasing puts, which paid off when the market hit bottom. However, Rogers stated he has learned that he is not good at short-term trading or timing the market. As a result, he found success by identifying cheap assets that are experiencing positive change and holding onto them for the long term. On the other hand, he also stated how he has also made money by selling assets or buying puts when there is widespread enthusiasm about a particular asset, indicating that it may be overvalued. He then emphasizes the importance of having staying power in order to be successful in these strategies. Listen to these carefully.
Well, I first went to China in I went to the Chinese Stock Exchange in 1990, and I'd been driving across China for a few years, and I could say, oh my gosh, this is not red China. This is not communist China. These people are, ambitious, hardworking, educated, disciplined, and they all want to get rich. So I started investing in China. That's 1990. You may know that China's been extremely successful since 1990. Yes, I figured out how to buy Chinese shares, and I bought Chinese shares. I still own Chinese shares. I have the original Chinese shares I haven't sold in 20 or 30 years. I want my children to own those shares someday, and they will think I was smart. If you sold your American shares in 1922, you might have looked smart for a while, but 50 years later, 100 years later, you look pretty dumb. That's my view of China, and who knows? It could certainly change, and something could happen that I would have to sell all of my Chinese shares, but at the moment, I still own all of my Chinese shares.
Based on Rogers' speech, it appears that he has had a positive experience with investing in China. He visited a Chinese stock exchange in 1990 and has been investing in Chinese shares since then. Rogers describes the people in China as ambitious, hardworking, educated, and disciplined, and he believes that China has been successful ever since 1990. According to Rogers, he still owns his original Chinese shares and plans to pass them down to his children, believing that they will be a good investment in the long term. However, Rogers acknowledges that circumstances could change, and he might need to sell his Chinese shares in the future, but for now, he assures that he remains invested in China. Listen to these carefully.
Well, I usually am hedged. I own some things and I am short some things. There's always something going wrong somewhere, and even no matter how good the market is, and I usually have sold something short in case, and likewise, I'm usually nearly always own something because there's always somebody doing right. There were people coming out of the 1930s very rich because they owned things and they knew what they were doing and they understood what was happening. So I usually try to be hedged, not completely or not in a big way, but if I get really bearish, I'll go very, very short. If I get really bullish, I'll get very, very long. So I never really know, but after a long time, you start to realize, you get to feel the pulse of what's going on. Right now, lots of new people are coming into the market. Stocks are very high. All of these people are calling their friends and saying, I've discovered this new thing called the stock market, and it's a lot of fun, and you can make money. And it's easy. It's easy to make money.
So easy.
Well, this is not my first rodeo, Kevin. I've seen this movie before. I know all of these signs come around. SPACs have been around for 300 years. But usually at the end of a long bull market, here they come again. Somebody rediscovers SPACs. So, as I say, I've seen this movie before.
Roger also discusses his approach to investing, which involves being hedged, meaning that he owns some assets and shorts others. He mentions that he tries to be hedged in a balanced way, and that he adjusts his investments depending on his level of bullishness, which we can rather say optimism, or bearishness, which we can say pessimism about the market. Rogers also mentions that he has experience in the market and has seen similar patterns before and cautions against getting too excited or caught up in the hype of a bull market. It's important not to get too excited or caught up in the hype of a bull market because it can lead to making impulsive and potentially costly investment decisions. During a bull market, asset prices tend to rise, creating a sense of optimism and encouraging people to invest more heavily. However, it's important to remember that all markets are cyclical and that bull markets eventually come to an end. When the market begins to turn bearish, prices can fall rapidly, leading to significant losses for investors who have become overinvested or who have taken on too much risk. Additionally, it's important to remember that no investment is guaranteed to succeed, and it's important to carefully consider any investment's risks and potential downsides before committing your money. This is especially true during a bull market, when it may be tempting to believe that the market will continue to rise indefinitely. It's always a good idea to diversify your portfolio and to have a long-term investment strategy in place to help manage risk and maximize your chances of success. Listen to these carefully.
All stocks are going up and stocks are selling at 20 or 30 times earnings. That's not a bear market. If all stocks have been collapsing and stocks are selling at 6 or 8 times earnings, that's not a bull market. So there's certainly some signs that one knows when things are cheap or when things are expensive, not to the day, not even to the month. But Kevin, I've been around a long time, I'm afraid. I've seen some of these things happen before, and many of the signs, for instance, in the big bubble in the late 60s, there was a laundry which changed its name to a computer company. Stock went through the roof. It was a laundry. But everybody was wild about computers in that particular bubble. These things happen all the time. You just have to be aware when there's madness going on, at least pick up on the madness. They believe in the hot tips. They think that whoever gave them the hot tips knows what they're doing. I have learned never, ever get involved with a hot tip, no matter who the source. If you get hot tip from the president of a company, you're probably going to lose half your money. If you get a hot tip from the chairman of the board, you're probably going to lose all your money. So stay away. Stay away from hot tips. Only invest in what you yourself know a lot about. If I told you, Kevin, you can only have 20 investments in your life, you'd be very careful. You wouldn't be jumping in and out, jumping around every week, every month, but you'd become a very successful investor. Now you might say, oh, but that's boring. Be boring. You want to be rich? Be boring. Just invest in things that you yourself know a lot about, and boy, will you be boring, but boy, will you be rich. Well, Kevin, everybody has to learn their own way. If you try to copy me or somebody else, you're probably going to make mistakes and lose money. If I told you that I'm doing X and you did it and it went up, you wouldn't know what to do. You don't know why you bought it. You don't know why you bought it. If it went down, oh my gosh, if it went down, you'd know what to do. You'd say, that Jim Rogers told me to buy this and it collapsed and he's an idiot. No, if you buy something and you know what you're doing, you'll know what to do if there are problems, you'll know what to do if things go wrong. But if you did it because of some hot tip or some guy on the internet, you're probably going to lose a lot of money. And you certainly don't know what to do if things go right or if things go wrong. Well, let's look around the world right now. I'll give you an example. Property in many countries is a bubble. If you go to New Zealand or Korea or many Australia, many places, property is certainly a bubble. For some parts of America. If you look at bonds, bonds have never been this expensive in the history of the world. Never have bonds been this expensive in world history. So that's not a bottom. That's some kind of bubble. If you look at stocks, many stocks, as we just discussed. Now, the stock market is not a bubble, not yet, if you ask me, but you can see some stocks are becoming bubbles. 10 cent was going up every day. Samsung was going up every day. Amazon, stocks like that. So you can see, as I say, I don't see the most stock markets as bubbles yet, but they're certainly not making bottoms. The only asset class that I can see that's still cheap are commodities. I mean, sugar is down 70% from its all-time high. Silver is down over 70% from its all-time high. Kevin, those are not bubble numbers when you're talking about that the assets are down 60, 70, 80% from the all-time high. So that's a way that I have enough experience to know that, oh, yes, many stocks on the New York Stock Exchange are making new highs. That's probably not a bottom.
Rogers discusses more on the concept of a bull market, which is characterized by rising stock prices and increased investor confidence. He argues that the current market, with stocks selling at 20 or 30 times earnings, is not a bull market because it is not a sustainable or balanced market. Rogers then advises investors to be aware of market madness and avoid hot tips or investments they do not understand. Instead, he suggests that investors should focus on investing in things they know a lot about and be boring but wealthy, rather than following trends or taking risks. Rogers also mentions that there are currently bubbles in the property market in certain countries such as New Zealand and Korea, while bonds in some parts of America are at an all-time high in terms of price. He advises investors to be aware of these bubbles and not get caught up in them. That's all for today. Kindly let us know your thoughts about everything discussed so far in the video in the comments section below. Remember to hit the like button and subscribe to our channel. Anticipate our next video update. Thanks for watching.